Hello everyone, I'm Nikhil Mishra from Setu Capital. It's going to be another small cap related stock discussion purely for educational purposes, and it is going to be after 2-3 weeks that I'm going to upload another video. So let's start the discussion. So this is one of the first type of stocks which I would be discussing. Mainly in the past, I have been taking up the China plus one or Europe plus one or chemical or pharma related stock discussions. This time it's going to be a pure domestic play into the retail, electronics retailing. So let me share the presentation with you. I have made it. So the company's name is Aditya Vision. So it's a regional electronics retailer. Electronics retailer means that it does similar kind of work which sorry similar kind of retailing which the Chroma or Reliance Digital does, that is AC, refrigerator, washing machine, your geyser and kitchen related item, etc. So this company is regional electronics retailer because it's currently present at only two places, that is in Bihar and Jharkhand, which are the most underpenetrated areas in our country. So this company, uh, meanwhile I was making the presentation. I just got the news that yesterday or day before yesterday, only the Mr. Ashish Kacholia, who has its own discretionary portfolio north of 3,000 crore rupees, entered the stock. He's a famous investor, and we have drawn a lot of inspiration from him. So this company, that is an added benefit about this company, and that gives us also confidence. So let's look at this company. So this company is undergoing a store expansion, is into its high growth phase, and there is going to be an operating leverage which is going to play out in this company. So, so let me give you an overview. This company was started by Mr. Yashovardhan Sinha, who is around who 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 has been a means banker for 15 years, and subsequent to that he started this retail electronics retail with a single store in Patna in 1999. From that point, in past 23 years, they have right now around 92 stores in Bihar and Jharkhand. To be precise, they have around 79 stores in Bihar and 13 in Jharkhand. Both are basically adjacent states. Previously, were under same Bihar state. This company is also undertaking expansion in FY23 and 24 into Chhattisgarh and West Bengal and UP, mainly the Hindi heartland, and then subsequently to the adjacent state of West Bengal. This company also has a group company which is listed in stock exchange by the name of Aditya Retail. So that basically does the food and beverage, saloons and grocery retailing, along with other restaurant related business at a single place. But the scope of that business is quite moderate versus the larger business which they have, that is the electronics retailing. So these are the product offering, basically the gadgets, or let's say the home home equipments, microwaves, dishwasher, refrigerators, hair dryers, trimmers, etc. Whatever you will find in a competing grocery Chroma or Reliance Digital or Vijay Sales or in South or Electronic Smart in Hyderabad, etc. Electronic Smart does have other branches as well, and it's a big competitor for it. So this let's look at the business aspects of this company. Now, fortunately or unfortunately, this company this company penetrates this company operates into the least penetrated state in India. Uh, Versus if you just look into the example of the refrigerators or air conditioners. For refrigerator, only 10% of households in Bihar have a refrigerator, while the national average is around 38%. For air conditioner, it's 5.6% versus the average household of in India of 24%. This company also has a bit of lumpy business where most of the revenues do come in the second half of the fiscal, mainly where the festivals and other holiday seasons aligns. And there is a summer season for which mainly the air conditioner or coolers related products are sold. This company's business model is I've taken this particular slide from the investor presentation, and they're trying to showcase the flywheel model over here. You can see, means this basically comes from the flywheel concept of good to great, the Jim Collins book, where where this is they are trying to create a flywheel so that more earnings, then more sales, they will be able to scale up the product, then they will be able to have bargaining power and um, get better margins, etc., versus the other retailers. And as you will have more customers, then you'll have higher sales, etc. So there is nothing much unique, to be frank, about the whole concept, and it's more or less similar for all retailers. Retailing, just in order to make you aware, is one of the toughest business models. It's one of the toughest business models to operate. The operating profit margins are hardly in single digits, while and net profit margins, even for top retailers, Walmart, DMart, etc., are in the range of lower single digits of 3-4%. Costco, for example, is an iconic brand in America, and Mr. Charlie Munger has been a great fan of Costco. It generally operates at a profit margin of around 3%. And whatever profit extra it makes sure that its customers get the benefit of it, which is good. So this they are, as per their future guidance, they are targeting around 150 stores from current 92 stores. So that will range to around 25-30% growth rate from the current 92 stores level. In the past as well, they have been growing at around 30-33%. So if we look into the financials, in the past 2 years, just remember one thing, that these past 2-3 years have been quite extraordinary, given the fact that this is a retail store and where the customers used to go. Most of the people were living at home, and very few. There were a lot of curbs and lockdowns, which led to the decline in the in the store visit. But still, this company has been able to maintain its revenue, and that's because mainly because they kept on adding stores even despite of the COVID impact. Company in its annual AGM also gave a data point that around 80% of the revenues are still coming from the pre-COVID era opened products. This company has been generating cash flows, which is a good thing, positive cash flows year on year, despite being having a moderate scale. Let's look at the margins. The company's margins in past 4 years have moved from around 1.6% to around 9.2%. If we take into account the post Indian accounting standards, which was introduced in around 23-4 years ago, 2-3 years ago, sorry. The PAT margins have improved from 0.6% to around 3.94%, which in itself is a good thing. Now, let me give you a caveat. Most of the large scale retailers or successful retailers, you'll find, generally operate at this net profit margins. This net profit margins. I'm talking about the profit margins. I'm not talking about the return on equity or return on capital employed. That may vary. But retailing being a tough business and there is a lot of competition, they more or less have to limit themselves to a certain extent. It's only that you are a niche retailer, then only you can have higher profit margins. But if you have, let's say, 5,000 plus SKUs of different products, and that too of mass retail consumers, then you won't be able to generate large margins. But the expansion in margins has been a very good phenomenon. That there is a combination of sales growth, store addition, along with that margin have improved. Higher margins or higher sales or scale gives them efficiency in terms of the management as well as a bargaining power from the original equipment manufacturers. So if we look into the store level metrics, so they have grown around 30 by at 33% CAGR for the past 5 years. In the upcoming 3 years, 2 years and 1 quarter, they are also targeting around 150 stores, which will also come in similar range. So they are targeting similar range of stores growth, which will lead to extra number of stores, and hence that will give you more sales, upcoming sales. If you look into a store unit economics at a particular store level, you'll find that it takes around 50 lakhs of capex for a single store, for the single store. Then it takes around 2 crore of working capital, means the inventory or yeah, inventory or the let's say the products which are kept in the store. Around per store there is 2 crore rupees. Less than 6 months for a break even of a store. And the payback period is around 3 years. The revenue generated per square feet is around 33,890 rupees for FY22, which is a good number. And if we look into the ROC and ROE, this company has been able to clock very high ROE and ROC. There is a reason behind it. We'll look into that in the upcoming slides. So it's a very high ROE business and ROC business. It's a low profit margin business, but it's a very high ROE and ROC business, which is a good thing because at the end of the day, this is the amount of capital which is employed into your business, and you are able to save. In the best businesses are those businesses in which you are you are able to generate high return on capital, and you have a long runway where you can keep on redeploying the same capital rather than giving it out as a dividend or share buyback. It's better to put the same amount of capital into your own business, which is able to generate again a higher ROE or ROC. Every incremental input into the own business is much more beneficial as compared to giving it away in terms of dividends. So coming on to the capital structure, if we simply take the total debt and total equity, then debt to equity comes out to around 3 times, which is considerably high. If you see that it is considerably high. If you take the same thing for electronic smart, you'll find that this comes around 1.5 times. But there is a catch over here. The most of the debt is in the form of lease liability, which gets into club because of the new accounting standard. It gets clubbed into total debt. So over here, the lease liability is around 117 crore rupees for the long term, and for the short term, the the lease liability is around 7 crore rupees. So it's not that the company has taken debt. The borrowings are relatively less. You can see that there is only 13 crore of long term borrowings, which they have taken from Axis Bank. And the current liabilities are 100 crore rupees. But this borrowing of 100 crore rupees in current liabilities showcases that the company does have working capital challenges, and there is a lot of capital which is stuck in stuck in the business because they have to finance their own working capital. And the same thing has been highlighted by CRISIL in the rating. CRISIL is a rating agency which does their rating of their bank instruments. So the CRISIL has highlighted the company relies on external debt to fund working capital requirement. Capital structure is marked by high gearing and total outside liabilities to tangible net worth. This was mainly due to substantial inventory, given the variety of products offered and seasonal nature of sales, typically towards the end of the fiscal. So the company has a leveraged capital structure. So going forward, if there are more efficiency, then it's expected that it will improve. But still, at this present moment, it's leveraged. If we look into the management remuneration, so Mr. Yashovardhan Sinha, who had started this company, takes around 2.4 crore rupees home. Nishant Prabhakar, Sunita Sinha, and Dhananjay Singh, etc. So, the main classification of the management remuneration can be seen that the promoter family or most of its members are drawing higher remuneration. But that is expected as far as this company is concerned and the scale and size and the challenges and the skill set which they bring forward. And then the CFO, it takes around 11.3 crore rupees, while the company secretary 5.85 crore rupees. Mr. Tushar Jha is the son-in-law of Mr. Yashovardhan Sinha. He acts as a management consultant and takes around 1.2 crore rupees. And there is another, means the daughter of Mr. Yashovardhan Sinha, who is a legal expert, takes around, I don't exactly remember what are her remuneration, but still they are relatively on the higher side compared to the other other staff, etc. Mr. Ajay Kumar, who is around 63 years old, takes around 1.14 crore rupees as remuneration. So, all in all, given the challenges and the prevailing standards, these are fine. These are these are nothing out of bound. Means just to highlight one thing, there is a company called as Gujarat Ambuja. I did a I did around I did uh, a, a video on that as well, discussing and analyzing the company. Over there, you will find that as since the promoter is taking around some percentages of profits, the total remuneration comes for the Mr. for the main promoter of the company comes around 200 crore rupees. So that is the sort of things which can happen. So that's why it is important for the minority investors to take into look into these factors. But over here, these are completely fine and justified. Coming on to the valuations. So this company seems to be seems to have seems to have recently got re-rated a lot. You can see that obviously the retail store was there since it was a retail store and pandemic had did hit most of the retail related stocks. Over here at present, the company trades at around 1.6 times sales. Price to earning is at around 34 times. Price to book seems quite high because the equity is quite low, and there has not been much equity infusion. The company has been able to generate its own capital and keep on redeploying in its own businesses. The company trades at a premium to recently listed electronics mart, but the metrics, although at a lower level, are much superior versus the electronics mart. So this was the basic discussion and analysis about this company, Aditya Vision, who are into a quite a very high growth phase. They are expanding their footprints, and they will be expanding into more states, and there will be more challenges because of it. Because as of now, they are they are into store places where there is not much competition from big box retailers like Chroma or Reliance Digital, etc. So it when they do enter the other areas where there are large retailers, then they will have to show their own metal, and then it would be in fact more interesting to see how the financials of these companies change and whether they are able to sustain their dominance which they have at present in the regional regions which they are present like Bihar and Jharkhand. So that brings us to the end of this presentation. I hope you did like my video or analysis in this. So do press the uh, thumbs up and don't forget to subscribe in case you guys do wish to watch more content related to stocks for educational purposes in mid cap, small cap, and micro caps. Then do subscribe and do click the bell icon as well so that you will be notified whenever I upload a new video. For any stock and mutual fund related services, do contact this number. One of us will be calling you and will be very helpful for providing you services in your wealth creation journey. For then you can do visit my website and or look into my YouTube channel as well and look into other videos which I have created in the past. Most of them are quite informative and in depth. So till then, thank you very much.